Hi, everyone. This is Tony D'Amico with Fidato Wealth. Thanks for joining me for this video. I wanted to do a video on the current market volatility and opportunities at hand. So the topics that we're going to review, again, the current volatility in the markets, some key things to focus on moving forward, what we're doing to manage risks, and opportunities at hand. So let's talk a little bit about how did we get here? So up to March of 2020, the economy was very strong. Unemployment was at record lows. Companies were doing well. The U.S. consumer was doing really well. So things were actually going very well in the economy. Not perfect, but overall very strong. Obviously, in March of 2020, COVID happened. So we had shutdowns, which was really the start of supply chain issues due to those shutdowns, and also due to labor issues, right? People getting COVID. Unemployment spiked, and we had the sharpest drop in the shortest period of time ever in the markets during that 33-day period. So and then since the onset of COVID, it's important to note that the U.S. government has injected $5.2 trillion into the economy. And that's all aspects of the economy. That's to consumers, to, people have gotten tax credits. So, we've done some meetings with clients that are, they're very secure financially. They didn't need a tax credit, but they received one anyway, kind of due to some of the changes around COVID. And there was really no way for them to give that money back. Now, not everyone wanted to give the money back, but some people did, some people didn't. But people got there was a lot of resources injected into the economy. There was, PPP loans. There was other things that happened. So quite a bit of money, again, was injected into the economy. And what we saw in the second half of the year was continued staffing shortages, continued supply chain issues, and high demand for goods and services, again, due to the strength of the U.S. consumer, right? Real estate, the demand for real estate has been unbelievable, right? There's certain areas of the country that real estate has grown tremendously. People are in a position where they can buy the house, or they have the financial wherewithal to do so. So again, demand has been high and supply has been low, which brings me back to my economics 101 class. And that obviously creates higher prices. 2021 was marked with persistent inflation, persistent demand, persistent labor shortages, and again, continued supply chain issues. However, those are some of the challenges. However, again, there's a lot of hiring that's occurring in 2021 and still currently. There are some bright spots that are in economic data as well. It is not all negative, so that's important to talk about. But 2021 inflation came in at about 7% for that calendar year, and heading into 2022, inflation has been running about 8% on a trailing 12-month basis. And obviously, again, we have high demand, low supply. We have a change in monetary policy. So we have the Fed is raising interest rates to try to cool off the economy and rein back in inflation. And they're also pulling back on some of that quantitative easing or stimulus that they've done to kind of facilitate the economy. And additionally, we have the Russia-Ukraine conflict. So these are all headwinds that we've had coming into 2022, again, marked by some positive things such as strong hiring and other aspects of the economy that, again, the data is either positive or neutral. But let's talk about recessions and what kind of some basic information or frequently asked questions on recession. So in normal economic conditions, a normal time would be steady, gradual growth. Now, we have not really experienced steady or gradual growth heading up to this market volatility, right? There's been some explosive growth in the markets the last several years. Since 1950, the economy has been in recession about 13% of the time and has been in expansion 87% of the time. So that's very helpful to know. And then what typically occurs alongside a recession? An economy is close to full employment. We're pretty close to the record employment levels that we were at at the end of 2019. Not quite there, but not in terrible shape at all. And again, hiring is still robust. The second thing that typically occurs alongside a recession is the economy gets hit by a major shock or surprise that cannot be predicted. So I think COVID definitely fits that definition. And then policymakers made some sort of mistake which worsened the situation. Now, I don't think we're in a position to say the Fed has made a mistake and raised interest rates too late. I think that's to be seen, and anyone could look in the rear view mirror, look in the past and know what was the right thing to do at that point in time. And I think this situation needs to play itself out. Let's take a look at how long recessions and expansions last. So the average expansion lasts 67 months, and the average recession is about 10 to 11 months in average. So if we include 2020, which was technically considered a very short recession, it brings the average recession to about 10 months. So you can see, while recessions are painful, expansions have been much more powerful. So expansions are kind of the teal shaded area, and recessions are the purple shaded areas. All right, so one more chart for you. This looks at the S&P 500, which is US large cap companies, and their performance in every recession since 1950, including the recession in 2020. Okay, so you can see during the recession, the average return was negative 1%. 6 months before, it was negative 2%. 12 months before, it was negative 3%. And then 6 months and afterwards, it's 7%. 12 months afterwards is 16%. And 2 years after, it's 20%. So what this tells us is that the markets actually, they have a downturn ahead of the actual recession. And we'll talk about why in the next screen. So some other recession facts. Again, since 1950, recessions have lasted roughly 10 months. The shortest was 2 months, which occurred during the pandemic, and the longest was in 2008, and that lasted 18 months. The S&P 500's worst performance, again, is usually observed in the 12 months leading up to the recession, rather than during the recession itself. Now, there are some exceptions to this, but this data point reaffirms that that markets are forward-looking while economic data is backward-looking. So what does that mean in plain English? So when you look at the S&P 500 for what it did for the day or other market data, that market data is pricing in what it thinks the future will be like, right? That's very important. While economic data, so for example, when a company reports earnings, they're reporting earnings for a previous period of time. So it's backward looking. So economic data is backward looking. Markets are pricing forward looking on its views of the future. So conventional thinking might say, oh, go to cash. Let's let the dust settle. And most I would say that the clients that work with us, they've worked with us for a while. They're getting advice and guidance through this. They're not thinking this way, but people that maybe don't work with an advisor, are not experienced investors, some folks are considering that, and that is really scary, because the truth of the matter is the economy can be giving some bad data, maybe poor earnings, but the stock market could be going higher and going higher very quickly. Why is that? It's because while there's bad economic conditions now, the markets are pricing in that the future that the economic data will be good. So again, markets are pricing in their expectations of the future, and they're doing that every day. So very important. Markets are pricing in anticipated strengthening economic conditions. Again, we talked about how after recessions, the returns increase the further out you extend from that recession. So again, 2 years after recession, S&P 500 returns on average were 20% higher. So very important. So let's just recap some strategies that are utilized to help you protect you from these risks. So number one, I think this is very important, is to remember what your investment plan and financial plan looked like when you first started being proactive with your planning efforts. When we have a client come in for a planning meeting and they've been a client with us for, let's say, 10 plus years, there's a tremendous amount of planning that's occurred. Obviously, all the things that we do to strengthen their investment and asset allocation plan, tax planning, managing withdrawals and for income, risk protection, estate planning, all of those things. I think it's really important to take a look at that, especially with the second item here is your diversification. So why do we diversify? We diversify not because of what we expect, but because of what we don't expect. So sometimes with a newer client that comes in for a planning meeting and they have questions, and we don't blame them, right, of the volatility and what's happening. Some of the things that we'll do is we'll actually pull up the Morningstar investment analysis of what their investments look like prior to starting working with us. And often, not all the times, but quite often, we'll see a lack of diversification or concentration in certain asset classes. So diversification is the name of the game when there's volatility and for the long term. Asset allocation, again, is really important. So really, it's spreading out monies across different types of assets and having, again, not just 5 funds in a portfolio, not just 7 funds, but in our portfolios, we have 14 funds where each fund is invested in a specific asset class. So that's really important. Rebalancing. So you guys know that we do rebalancing. We look at that at least on a quarterly basis. During that COVID drop, we actually rebalanced 7 times to take advantage of it because the markets were so quickly moving. This pullback has a little bit of a different feel to it. We're still remaining disciplined and rebalancing, and we're going to continue to rebalance to take advantage of the volatility in the market. Ongoing institutional manager due diligence. I think this is another really important thing to remind our clients that of what we're doing for them on an ongoing basis. So I actually had the chance to interview somebody from Dimensional Fund Advisors, and I think you'd find that interview really helpful. It's also on our YouTube channel. But we talked about how there's certain areas of the market where having a manager that's reviewing holdings on a daily basis and monitoring things is important. So I'll kind of use the Dimensional Fund's Emerging Markets Fund. So it's a small piece of the portfolio. It's about 3.6% of our moderate portfolio. But that fund, as of the end of March, was down about 3.5%, looking back at the past 12 months. But when we compared that to an emerging markets ETF fund that was just very passive in nature, it was down about 11% over that same period of time. And so emerging markets is one of those areas where having that management on a daily basis, reviewing holdings, making decisions like that is really important. So they've done some phenomenal things with that fund. It's one of their staple funds of having a really great long-term track record. And, there's many other different parts of the market too, where having that ongoing management is very important. And that could include international, emerging markets, as we discussed, small cap, large value, different areas of the bond market. So very important. Comprehensive financial planning, I think, is paramount, right? Having a plan that has an adequate probability of success that you're comfortable with, having an investment plan that is anchored to that financial plan, right? Where that you have a certain probability of success, it factors in randomness of returns, some market volatility, good situations, bad situations. So again, your plan is not built for one recession. Your plan is not built for one economic cycle. Your plan is not built for one presidential election. Your plan is built for the remainder of your life. Your plan is built with more of the long view ahead. So very important to remember that. And really relentless discipline, I think, is absolutely paramount. So actually Warren Buffett and his company, Berkshire Hathaway, they're buying stocks right now, a lot of stocks. They are investing a lot of the cash that they have and buying different stocks. So again, it's kind of a crude quote, but it's, I guess you can say that, but it's accurate. It's be fearful when others are greedy, be greedy when others are fearful. So I think that's really the name of the game, is to stay disciplined. And the way that I translate that quote from Warren Buffett, because that's who I'm quoting there, is to use these events in an opportunistic manner. We employ what's called a dynamic withdrawal strategy for our clients. So that's for our clients that are withdrawing from their investments. We are very strategic on what positions we're liquidating, and obviously trying to sell the positions that are up the most to fund their distributions, and being very strategic about that and evaluating that on an annual basis. So focusing on opportunities, I think it's important to indicate that, we want to help you control what you can control, and sticking to your plan does not equal doing nothing. So some common things that we'll help our clients with when they come in for a planning meeting is, we'll evaluate debt structuring. Is there any debts that could be restructured to improve their financial situation? Tax planning. Tax planning provides a substantial benefit when there's tax planning opportunities. So we do a lot of Roth conversions. So that's important to talk about as well. It sometimes makes sense to accelerate Roth conversions when the markets are down. Investing, if you have extra cash on hand, the markets have been down, and I think it's a great opportunity. Markets can still go down, but again, if your emergency account is overfunded, perhaps you have extra funds, whatever it might be, I would strongly consider you investing those funds. And also keep in mind that 401k limits, how much you can contribute to a 401k, was raised slightly for 2022. So you want to make sure that you're taking advantage of those increased limits. If you typically make contributions to an IRA, Roth IRA, or other non-qualified investment account, you may want to consider making those contributions now, again, to take advantage of lower prices. If you have any assets with a tax loss, it might make sense to harvest that loss to reduce your tax liability. Are you planning to retire in the near future? If so, it may make sense to revisit your plan to ensure that you're comfortable. I think it's important to note too is, with our clients, it's, again, remember that you've been through downturns before. So far, every downturn has led to a recovery and then some. So we know that typically the best days in the market occur right after the worst days. So it's all about being patient and disciplined. I know you've heard that, but I'm going on 20 plus years now in personal finance, and that has come true so far with every economic cycle. And so far, I have not met someone that broke discipline and did not regret it later. So I think discipline and really following the plan is paramount again, but that doesn't mean not doing anything. If you're planning to make a major purchase, if so, are those funds in cash already? If not, you may want to reconsider the timing of that purchase. And these are all things that we can help you plan for, right? The more that we know ahead of time, the more we can help you be proactive and be prepared for these goals. And then lastly, if you have other planning areas that we've identified with you that maybe you haven't taken action on yet and still need your attention, again, I think, again, focusing on what you can control is the name of the game and the really the most important thing to do. All right. So in conclusion, I'll remember to ask you to remember two things. So one, again, markets are forward looking while economic data is backward looking. So just remember that whatever the markets end up today, it's a reflection of what they anticipate for future earnings, not what the earnings are now. Okay, so very important. Remember what your investment plan and financial plan looked like when you first started being proactive with your planning efforts. I think, again, that's really important. You know, our clients get a really nice performance report. It tracks their performance since inception and working with us to the most recent quarter end. And I always tell clients, I wish that we had the data for you that showed you that investment, the change in your investments due to the markets going back to the first day you started investing. I think that would put things in tremendous perspective because, you know, now when a client comes in and they have 10 years plus of history with us, they're a longer term client, you know, there's a longer term trend here. And, you know, yes, there's volatility, but it's a kind of a smaller bump in the graph versus somebody that's been with us a year or two. You know, their investment chart looks more like an EKG machine, right? Because markets have been volatile, right? But again, that's where that long-term perspective comes into place. And that's where our job is to educate our clients. The next thing is just keep in mind and really avoid at all costs associated with the term, this time it will be different. Again, I haven't met anybody yet that made a decision around their finances that was based upon this term. and I heard that they were happy with it. Maybe they were, but I don't think so. I think that's really, really, again, as the words say here, avoid at all costs anything associated with that term. Keep the long term in mind first and foremost. So again, your plans were built for the long term. They weren't built for one cycle. They weren't built just for sunny days. Turn off the news for a bit. Not a lot of good news out there. And it's a science, actually, that good news actually, unfortunately, doesn't sell, but it's a science that fear and greed do sell. They sell ad space and everything else. So I think that's important to understand. You know, when the news starts off, there's always this dramatic music, right? It's never like this peaceful music, right? Because that's not what gets people's attention. I think it's really healthy to turn off your news and really keep that manageable. And then lastly, take opportunistic actions that are in your best interest. So I hope this video helped you. Hopefully there's some new concepts that will perhaps provide you clarity, and know that we are here as your fiduciary to look out for your best interest, to help you with your planning and help you keep things on track. So again, thanks for joining me today, and I hope you all have a great day. Thanks and take care. Bye-bye.